Good afternoon, everyone. Welcome to this afternoon's Lunch and Learn session, where we will focus on the key aspects which were contained in the Finance Bill, which was published on the 21st of October. I'm delighted to be joined by my colleagues, Talia O'Toole, John Doran, Lorraine Mulligan, and Edna Kennan, who will run through some of the key aspects that were contained in a quite detailed Finance Bill that was published in October. There is also a Q&A function available with this facility. So therefore, if anyone has any questions, please just type them into the Q&A function, because we'll have hopefully about 10 minutes at the end of the session to run through any questions people may have. So without further ado, I'd like to hand over to my colleague, Talia O'Toole, who will kick off the session. Thank you.
Thank you, Brian, and welcome everyone. So as Brian mentioned, I will be focusing on the key employment tax provisions announced in the Finance Bill. So let's move to remote working. So the Finance Bill announced a new section 114 Cap A, which introduces statutory tax relief for employees to claim in relation to electricity, heating and internet costs associated with working from home. And this section has effect from the start of 2022. Now, there are a number of conditions for the employee to meet in order to claim the relief. The first being that they must be working from a qualifying residence. Now, that is defined as a dwelling house or part of a dwelling house which is occupied as the main residence of the remote worker. A remote worker is defined as one holding an office or employment of profit and who performs the duties fully or partly from that qualifying residence. And in order to claim the relief, vouched relevant expenses, so those electricity, heating and internet costs, must be provided to revenue as part of the claim. So the employee can only claim in relation to expenses they've personally borne, and any employer costs reimbursed cannot be claimed. So if we move on. So in order to calculate the relief, which is given by way of a pre-tax deduction, the formula is 30% of the relevant expenses times the number of days spent working at home over 365. And from that value, any employer contributions which have been made both indirectly or directly towards the cost for the employee must be deducted. Now, that doesn't realise a huge amount of money in terms of a value to the employee, because the pre-tax deduction will be either at 20% or 40%, depending upon the marginal tax rate for the employee. When we compare the statutory provisions with the current revenue guidance, which relates to the eWorker TDM, that relief covers only 10% of electricity and gas costs, but 30% broadband as the statutory provisions provide. Most interestingly, though, the eWorker relief provided for under revenue guidance requires a written agreement to be in place between the individual and the company in order to claim the relief. Now, that relief or requirement was relaxed for the COVID restriction period. There's no such requirement built into the statutory provisions for 2022. In relation to what counts as a day spent working at home, again, the current revenue guidance is slightly more restrictive than the statutory provisions. Days under the eWorkers provisions exclude days where you've spent part of the day working from home, but part of the day at a temporary workplace and have claimed travel or subsistence costs. So again, that relief is not, or those measures are not included within the statutory provisions for 2022. Moving on. We're going to focus now on some benefit in kind changes, the first being in relation to healthcare. So there are several pre-existing BIK concessions in relation to healthcare, which are now in statutory footing as a result of the bill. And those provisions will have retrospective effect from the 1st of January 2021. Now, the relief only relates to healthcare benefits which have been incurred by the company or the employer, provided they've been made generally available to all employees or directors. So if, as part of your reward structure, certain healthcare benefits are only provided to a group of employees, the benefit in kind exemption for that group of employees won't be available. The type of healthcare benefits that have been covered by the new provisions, they relate to the medical checkup, which is an annual checkup by a medical practitioner, or it can be more than once, where under the terms of your employment contract, there is a requirement for a number of tests throughout the year. COVID-19 tests, where it's connected to the carrying out of the performance of the duties of the employment. Flu vaccine, which can be either employer paid or reimbursed to the employee. And then interestingly, healthcare and other related expenses as defined under section 469 of the Act. Now 469 of the Act is the section that you or I would make a claim to Irish Revenue for medical expenses that we've incurred during the year. So typically that's your GPs, your physiotherapy, your x-rays, your prescription drugs, and so on. Now, important point to note under those provisions is generally most of the activity that you're claiming for has been either recommended by a GP or has been a referral from a medical practitioner. So I suppose the point to note here is that in relation to maybe EAP programs, we would be expecting most of the benefits provided under those programs to be exempt as a result of this statutory provision. However, more holistic services may not necessarily be exempt because they need to fall into the criteria of practitioner for section 469. Moving on. Just in relation to electric vehicles, the current rules, which were due to expire at the end of December 2022 in relation to cars and vans, provided for a complete BIK exemption where the open market value at date of first registration was less than or equal to €50,000. Where the open market value exceeded €50,000, the BIK percentage was calculated as the excess above the open market excess of the open market value above €50,000. So the finance bill provides ongoing relief for electric vehicles, but on a reducing scale. So the relevant threshold in which to benchmark your open market value will be 35,000 for 2023, reducing to 20,000 for 2024, and then 10,000 for 2025. Put that in context, if you have an individual who pays 30% BIK annually and has a €60,000 car, the annual BIK would increase from €3,000 for 2022 to €7,500 for 2023, all the way up to €15,000 for 2025. And naturally, there will be a corresponding increase in employer PRSI liabilities for the business as well. Moving on. So a measure was introduced in relation to international flight crew and amends section 127B of the Act, which provides that airlines who have their place of effective management in Ireland must operate Irish PAYE withholding in relation to crew members in international flights. And that's notwithstanding the individuals in question, maybe not Irish resident, nor perform any duties in Ireland. And that naturally can cause administrative difficulties for airlines as well as personal tax implications for the crew members involved. So from 2022, this provision is relaxed, provided the individual in question is not Irish resident, is resident in a tax treaty location, and will be liable to tax in that tax treaty location as a result of their residence there. So employers in this space should consider applying for a PAYE exclusion order in advance of 2022, or indeed consider whether they can place reliance on the concession from applying for a PAYE exclusion order, where the individual has been recruited outside of Ireland, is not resident, and will not perform any Irish workdays during the tax year. Moving on. So a phased exit arrangements in relation to the EWSS were provided for in the bill. These relate to the period from the 1st of December 2021 through to the end of the scheme, which finishes on the 30th of April 2022. So there are effectively 3 periods in question between now and then. So the period up to 30 November 2021, the existing rates payable as a subsidy per qualifying employee remain, and there are no changes to the employer PRSI reduced rates that are available. For the period 1 December 2021 through to 28th of February 2022, there is a 2-tier rate structure of €150, €1.50 or €203 per week, depending upon the pay scale in question, and the employer PRSI reduced rate continues to apply. If we move to the third tier, please, next slide, please, Sarah. So from 1 March 2022 until 30 April 2022, which is the end of the scheme, there will be a flat rate of €100 per employee, but the employer PRSI rate would increase to normal rates. A couple of other small provisions in relation to the EWSS. If you're an existing claimant as at the 31st of December, and you'll continue to have eligibility due to the 30% reduction in turnover requirement, there will be no obligation to perform the monthly formal reconciliation to determine ongoing eligibility for the scheme for the period January to April 2023. And lastly, in relation to the EWSS, no new entrants will be available from the 1st of January 2022. For those wishing to claim for 2022 must be already claiming by the 31st of December. Moving on. So a number of measures were announced in relation to pension benefits, but I'm going to focus on key measures in relation to occupational pension schemes. And there are two key measures which are effective from the 1st of January 2022. The first relates to death and service benefits, which are received from an occupational pension scheme on the death of an employee. The provision is now made for those pension benefits, or that contribution rather, to be transferred into an ARF facility or taken as a pension benefit. And the second category in relation to occupational pension schemes is the relaxation of the rule which prohibited a member of an OPS who had 15 years or more membership of the scheme. They traditionally could not transfer their pension benefit to a PRSA. From the 1st of January 2022, that rule has now been relaxed. And finally, moving on to PAYE and debt warehousing. A couple of small points here in relation to individuals who hold a material interest in their employing company. Now, a material interest is defined as holding 15% or more of the ordinary share capital of the company. And the bill addresses 2 points in relation to those individuals. The first addresses an anomaly that was arising as a result of a separate tax provision, which denies a director or an employee who holds a material interest a credit for PAYE that has been withheld from their pay, where that PAYE has not been paid over by the company to Irish Revenue. And naturally, as part of a debt warehousing arrangement, the PAYE due has not been paid over to Revenue. So such individuals were finding when they went to complete their self-assessment tax returns that the full liability on such income was being crystallised and sought for payment, notwithstanding PAYE had been withheld from that pay throughout the year. So the first point is to address this and enable the individuals to effectively avail of debt warehousing on that proportion of the income tax due, provided it relates to the employment income which has been warehoused by the employing company. And the last point in relation to PAYE and debt warehousing also relates to material interest holders. For both the individual in its personal capacity and the company have availed of debt warehousing, any interest due on employment income remains payable by the employing company, except to the extent the employing company has defaulted on its arrangement with the Collector General as part of the warehousing scheme. In such an instance, all relevant liabilities will be for the individual account. So with that, I will pass you over to John Doran.
Thank you, Dahlia, and good afternoon, everybody. So what I propose to do is just to bring you on a quick whistle-stop tour of some corporate and business tax matters that were included in the Finance Bill. So first up on the agenda is the Digital Games Corporation Tax Credit. So the purpose of this new credit is to support employment growth in the digital gaming sector in Ireland, and to also provide an incentive to produce games that promote European or Irish culture. In terms of the scope of the regime will cover expenditure incurred on the design, production and testing of a digital game. The thresholds have been set at a maximum expenditure of 25 million, with a minimum expenditure set at 100,000. And the headline rate is 32%. So the maximum credit that a company can claim would be 8 million. a key component of the new regime will be that the game must be certified by the Minister for Tourism, Culture, Arts, Gaeltacht Sports and Media. Next slide, please. So in terms of the calculation of the credit, as I said, the headline rate is set at 32%. That's 32% of the lower of the eligible expenditure, 80% of qualifying expenditure, or 25 million euros. With qualifying expenditure being expenditure incurred on the design, production, and testing of the game, and eligible expenditure being that proportion of that expenditure expended in Ireland or the EEA. So next slide, please. In terms of how the credit is utilised, it can be used to offset corporation tax liabilities, or in effect received as a cash refund by virtue of the fact that it will be treated as an overpayment of corporation tax. Next slide, please. So the legislation also provides for an interim digital games corporation tax credit, which will effectively enable the company to claim a credit before the game is completed. As I said earlier, the game must be certified, and that certification is subject to a cultural test that will take into account factors such as, whether the backing track is composed by an Irish composer, or if it promotes ecosystems within the EU or Ireland. So I guess extreme example, a litter picking game with a Christy Moore backing track would tick the box. In terms of what can't qualify, you can't claim a credit for any relief that's already relieved under the R&D tax credit regime or film relief. Excluded games would include games that are for promotional or advertising purposes or for gambling purposes. The regime will apply until 31 December 2025, but if it's a success, I'm sure it'll be extended, and it's subject to a commencement order under EU state aid rules. So next slide, please. So just moving on to some business incentives then. First up, the relief for startup companies. So as the Minister announced in his budget speech, this exemption or this relief from corporation tax has been extended up until 2026. And also the period for which a startup company can claim this relief from corporation tax has been extended from 3 years to 5 years for companies that commence trading on or after 1 January 2018. And the purpose of that change is to largely take into account the hardships which were suffered by small businesses during the course of the pandemic. So next slide. So yes, so moving on to the EII scheme, just quickly by way of recap before we talk about the finance bill changes. So the EII scheme is there to promote investment in SMEs by investors. The tax relief is available at the marginal rate for investment up to 250,000, where the holding period is set at 4 years, with that being increased to a threshold of 500,000, where the investor agrees to hold his shares for a 7-year period. So from the SME's perspective, they can raise 5 million per annum, subject to an overall limit of 15 million. The qualifying EII investments, they can currently be made through a designated investment fund that's set up as an irrevocable trust. EII companies can redeem shares from members once they're outside of their compliance period, which refer to as the capital redemption window, without triggering a clawback of the relief that they've claimed. And just by way of some historical comment, and for reasons we'll get onto in a minute, for EII funding prior to 8 October 2019, the relief was available in 2 phases, with the second phase only being available once certain employment growth or R&D and innovation thresholds were met. So if we just move on to the next slide, please. So in terms of the amendments then that have been proposed in the finance bill, so the regime has been extended by a further 3 years out to 2024. The bill includes changes relating to the statement of qualification that an EII company would issue to an investor. First of all, there's a removal of the requirement that 30% of the funds raised must be first expended on for qualifying purposes. And there's also a change which reduces the time limit allowed to the SME to issue the statement of qualification. So that's reduced to 4 months. For shares that are issued on or after 1 January 2022, a quarter of the relief will be subject to clawback in the event that the thresholds that I mentioned that were there historically, if they're not met, then one quarter of the relief is subject to clawback. And that clawback would be effectively assessed on the SME itself by way of a charge under Case 4. The bill extends the range of investment funds that can qualify to beyond designated investment funds, and will now include the likes of an investment limited partnership. And then final point is just there's a relaxation of the rules around the capital redemption window, which would essentially enable certain investors who meet certain criteria, and indeed the SME itself would have to meet certain criteria to effectively redeem out or repurchase the investor shares without triggering a clawback. So if you move on to the next slide, please. And you can move on to next. Yes, so the finance bill also includes some developments in relation to non-resident corporate landlords. So historically, such landlords were subject to income tax on rental income from Irish properties at a rate of 20%. The finance bill proposes that with effect from 1 January 2022, that rental income will instead be subject to corporation tax at a 25% rate. So there's a 5% increase in the rate of tax. Capital gains will also be subject to corporation tax, but there effect no change in effective rate, which will remain at 33%. There are the certain transitional provisions with respect to both losses and capital allowances, pursuant to the move from one regime to the next. So, for example, if there is a balancing charge that arises post 1 January 2022, only 80% of that balancing charge would be taxable at a rate of 25%. And importantly, the non-resident landlords, as a consequence of now being subject to corporation tax, those landlords will now also be subject to the same interest limitation rules as Irish domestic landlords will be subject to, and Lorraine will talk about that later on. So if we can move on to the next slide, please. And I need the next one. So the finance bill also includes changes to Section 840A interest restrictions. And just by way of quick recap, 840A effectively can deny a deduction for interest payable on a connected party loan, where that loan is used to fund the purchase of assets from another connected party, subject to certain exemptions. So, for example, trading stock wouldn't be within scope. The finance bill effectively extends those provisions to now include promissory notes and similar type arrangements, and also to include, it also extends it to the refinancing of loans that are in scope of 840A. And kind of in connection with the previous point that I was just discussing in relation to non-Irish corporate landlords, that they too will now be subject to these rules. So 840A could now impact these non-resident landlords with effect from 1 January 2022. So moving on to the next slide, please. So just a quick update in relation to revenue settlements. So with respect to penalties for deliberately or carelessly making an incorrect return, the finance bill essentially includes a rewriting of the pre-existing provisions. The provisions are largely the same, but there are some important differences that are worth calling out. So first of all, the prohibition on making a qualifying disclosure for offshore matters, that's now been removed. And also the bill legislates for the previous administrative practice regarding the non-application for penalties where a settlement is less than 6,000, excluding cases where it was an act of deliberate behaviour. Also, there will be no penalty in circumstances where there's a technical adjustment, or indeed where there's an innocent error. So these concepts were already a feature of the Audit Code of Practice, that they've now been imported into the Taxes Acts, albeit the meaning of these concepts will still need to refer to the Audit Code of Practice to get an understanding of what these concepts are. Moving on to the publication of tax defaulters. I'm sorry, if you just go back to the last slide. The publication of the settlements with tax defaulters. There's been also a rewriting of the legislation that governs publication. Some important changes that are worth calling out. I think that the most important one is in terms of the threshold. So historically, the threshold for publication was where the settlement amount was 35,000, inclusive of tax, interest, and penalties. That's now been changed so that it's only settlements where the tax liability is in excess of 50,000 will result in publication. And just by way of context, if we were to look at the last list of tax defaulters, I think there's about 18 featured on the list. but as a consequence of this change, about 12 of those would no longer be published because of the increase in the threshold. There are some other small changes. For example, in cases where a taxpayer may have used a previous name, those details can now be included in what's published. And so if you can move on. So next on the agenda is the new residential zoned land tax. So this new tax is essentially replacing the vacant site levy. The purpose of it is to encourage the use of land for residential dwellings, and not for the purpose of raising tax, according to the minister. The rate is set at 3% of the market value of the land on the valuation date. It will only apply to relevant sites. So what is a relevant site? Well, the site, it mustn't include residential property. It must be included on the final map produced by the local authority. And in terms of the criteria that the local authority must take into account in preparing this map, the land must be zoned residential or a mixed use, including residential. It must be reasonable to consider that the site has the necessary access and sufficient capacity to public infrastructure. So what are we talking about there? We're talking about roadways, lighting, sewage systems, etc. And the physical condition of the site can't preclude the erection of dwelling houses. So the types of things that would apply as regards to physical condition will be if the land, for example, was contaminated, or if there was historic ruins on the site, then it wouldn't and shouldn't be included on the map. There are a number of exclusions provided for. Firstly, if it's already an existing dwelling or curtilage, that's excluded. Where land is in use for a trade or profession that is liable to commercial rates and serves adjacent residential areas, that should also be excluded. Excluded is sites that are subject to the derelict site levy, and also land that's required for key community infrastructure, be it transport, energy, telecommunications, etc., and indeed educational schools, etc. And just a final note is that there's no minimum size exclusion included, so any size site is potentially within scope of this new tax. If you could move on, please. So as I said, mapping is central to this process, and as the local authority will prepare the map, there's a detailed process set out in terms of the sequence of events that should happen. There will be a draft map published, and then there will be various timelines within which people have the ability to appeal the inclusion of their site on the draft map. Landowners can also make an application to have their loan or to have their land dezoned, so rezoned as agricultural land, perhaps. The first final map is due to be published on the 1st of December 2023, and that will be for sites meeting the criteria on the 1st of January 2022. And then from 2025 onwards, a new map will be published on the 31st of January each year. And then in respect of those subsequent maps, there will be a similar process in terms of the ability to make an appeal. Next slide, please. So just some further details in relation to the new tax. So the valuation date would be the 1st of February each year, and then there's a revaluation required every 3 years. The tax payable isn't deductible in computing income tax, corporation tax, or capital gains tax. For land that's owned residential or mixed use, including residential, before the 1st of January 2022, there's a 2-year lead time with the new tax applying in 2024. Where the zoning happens after the 1st of January 2022, the tax will apply in the 3rd year after land is owned residential or mixed use residential. And then the legislation also permits the deferral of the tax in certain scenarios, including where, for example, there's an appeal underway, or there's a commencement order, has been lodged with the local authority in terms of development that's taking place, and that deferral can transition into an outright exemption. You know, if, for example, the appeal is successful, or indeed that the dwelling houses that have commenced development that they're completed within the time permitted. So next slide, please. So just some final points to note. It'll be on a self-assessment basis. The return will be due on the 23rd of May each year. For land where there's multiple owners, there will be joint and several liability. And for late payments, there's a rate of 8% interest will be applied. For instances where there's an undervaluation of land or a late filing, there will be a surcharge applied ranging between 10 to 30%, and any unpaid tax would become a charge on the land. So next slide, please. So yes, so just a capital acquisition tax. And sorry, before I just talk about this, just one point to go back on in terms of the revenue settlements. Just I should have also noted that those provisions will similar provisions will apply with respect to other tax heads, including VAT. With respect to CAT, just one point to bring to your attention before I hand over to Lorraine, and it relates to the free use of money. So there's a long-standing practice whereby free use of money is an interest-free loan. The benefit that was assessed for CAT purposes was effectively the best price obtainable in the open market for the free use or enjoyment of money, and that was determined by reference to the best available deposit rate with a retail bank. So the Finance Bill expands on the section and says that effectively that best price obtainable should be determined by reference to the best price obtainable on borrowing an equivalent amount of money in the open market. So that raises a couple of questions. One is who is this hypothetical borrower that we're talking about? So if, for example, a parent lends to a child, is it the rate at which the parent can borrow, or is it the rate at which the child can borrow? What's the reference date for assessing this best rate? And should the use of the funds be taken into account? So is it for the purposes of purchasing a house, or is it for the purposes of taking a round the world trip? So really just to flag that for your attention, and it's one to watch. So I think that wraps up the items that I wanted to cover. So I'll hand you over to Lorraine.
Thanks very much, John. So today I'm going to bring you through the business tax international aspects. So if you move on to the next slide, the EU Anti-Tax Avoidance Directive, agreed back in 2016 and subsequently amended, brought through 5 particular anti-avoidance, we'll say, provisions, and we have 3 fully implemented, and the last 2 are to go in this finance bill. So firstly, I'm going to speak through the interest restriction, or also known as the interest limitation rule. This will apply for accounting periods beginning on or after 1 January 2022. So moving on to the next slide, what we have is a flow chart. Now, this is a very simplified diagram of incredibly complex and difficult legislation. In that, whilst the legislation might be easy to understand, it provides substantial amount of options for taxpayers to decide. So it'll very much be fact dependent on your business on how this will impact you. So let's have a look at the first step here. It's to decide whether you're in the category of not in scope or can avail of the exemption. And there's 4 categories within this. On the next slide, you'll see the first one is that our interest, sorry, just onto the next slide there, Sarah, thanks. Is the net interest expense less than or equal to 3 million? This is considered the de minimis. So if your net interest expense is less than or equal to 3 million, then you're not within the interest limitation rule. However, this is an all or nothing. So if your interest expense is 3,000,001, you're very much within the interest limitation rule for all of your 3,000,001 interest expense. The next one is the standalone entities exemption. This exemption is very limited in its application, in that the company must not form part of a consolidated group for financial accounting purposes. It must have no associated enterprises, which is about 25% ownership or voting rights or profits, or has that in another company. Or sorry, it's not even confined to company, it's enterprise, so it can include an individual, and does not have a PE. If you qualify for a standalone entity, all of your interest expense is deductible and not within the interest limitation rule. The next is the grandfathering clause. So if you have borrowing costs that are associated with the loan that was agreed prior to the 17th of June 2016, to the extent it hasn't been modified, that interest expense will not be within the interest limitation rule, and we call that legacy debt interest expense. The final one is the long-term public infrastructure, and this is for long-term public infrastructure projects as they pose little or no risk of base erosion and profit shifting. It's very specific in its application in that the project operator, the borrowing costs, the assets and the income, they must all be within the EU. And the large scale asset must be a qualifying large scale asset as defined in the legislation. In those instances, interest expense related to that will be outside the interest limitation rule. So if we move on to the next slide, and you find that so when we're having a look at the de minimis, we have to look at our net interest expense. So the question is, what is defined as interest expense for the purposes of the ILR or the interest limitation rule? So it's the interest expense and any amounts economically equivalent to interest. And whilst the section is not complete in its definition, it does give some examples, such as discounts created on the issue of securities, guarantee or arrangement and commitment fees, foreign exchange movements on interest, finance elements of a finance lease, a slice of the operating lease rentals for trading lessors, and anything that could be reasonably considered to be economically equivalent to interest. This is what is considered to be the borrowing cost. It is also the equivalent for interest income when we come later on in the slide. So on the next slide, you'll see if you do not fall into the categories or the exemption or not in scope, then you need to look and assess whether in your business are exceeding borrowing costs less than or greater than 30% of EBITDA. And this is a tax EBITDA. So let's have a look on the next slide where we see that it goes through what is the fixed ratio rule. So this exceeding borrowing costs less than or equal to 30% of tax EBITDA. This is all allowable deductions. Any amounts in excess of this may be disallowed. So what are exceeding borrowing costs? It's tax deductible interest expense, less any amount that relates to legacy debt, because that should be exempt, less any taxable interest income. What's important here is we need a tax deduction or a taxable income in order to be considered exceeding borrowing costs. Then when we compare this to the 30% of tax EBITDA, we typically know EBITDA as an accounting term, but in this instance, it's tax EBITDA. We take the relevant profits, which is defined, and I've simplified here. You could consider it something like your taxable profits. You add back your exceeding borrowing costs. You adjust for capital allowances and balancing charges. You add your deductible borrowing costs for your legacy debt and any foreign tax deduction. Where this gets incredibly complicated is the fact in Ireland we have three tax rates that can apply to companies: the 12.5%, the 25%, and the 33%. When we're looking at, say, deductible interest expense, we must value adjust for that depending on the rate it's deducted from, depending on the rate it's on which income it's deducted from. So say take 25% rental income. If you have an interest expense deductible from your case 5 rental income, that will be valued as twice the amount of that which is deductible from trading income at 12.5%. And this is where a lot of complications arise. Let's have a look on the next slide. If we find we do have exceeding borrowing costs greater than 30% of tax EBITDA, do not worry, all is not lost yet. We might have relief under either the group ratio or the equity ratio rule. So on the next slide, let's have a look at what these ratio rules do. So the first one being the equity ratio, and these are all based on your financial statements. They're not tax adjusted. So we're looking to the consolidated worldwide group financial statements and the financial statements of the relevant entity. And the relevant entity can either be a company or can be all companies in the interest group, dependent on what you've chosen in your interest group. When we have a look at this, we take the equity over total assets percentage for the relevant entity from its financial statements, and provided that's greater than or equal to 98% of the worldwide group's equity over total assets, then all the interest expense is allowable. That's both external and that's both third party and related to interest expense. So there's no limitation on it. So this is an all or nothing really. If you can get into this provision, then all your interest expense will be deductible. However, this can be quite difficult to calculate because both the relevant entity and the worldwide group must calculate these ratios under the same GAAP. And we know that's not always the instance where companies perhaps in Europe calculate or work out their accounts under IFRS, but it consolidates into US GAAP. What's the next option is the group ratio here. When we look at that 30% of tax EBITDA, the group ratio allows for that 30% to be increased depending on what the ratio comes out of this. So we take again the group financial accounting statements and we take the group net interest expense over the group EBITDA, and that's an accounting term, group EBITDA. And if that gives us a percentage higher than 30%, when we look to that fixed ratio rule, what we're doing is we're taking that higher percentage times tax EBITDA, and that's what will be allowable. If we have a look on the next slide, if you can't get into or if you are higher than 30% of tax EBITDA, and you can't get into one of the group ratio or equity ratio, the interest limitation rule will apply. So on the next slide, we'll have a look at how the interest limitation rule applies. So the amount in excess of 30% of tax EBITDA will be considered the disallowable amount. That is then allocated to interest group members to the extent they have deductible interest. So if it's just a one company instance, you can allocate it to that one company, or you can pick and choose who in the group takes the disallowable amount. Then what happens to the disallowable amount is it reduces the deductible interest. So if you had case 5 interest expense, that's now reduced by the disallowable amount, resulting in higher case 5 profits and more tax to pay. However, that carry forward disallowed amount can be carried forward indefinitely and will reduce total profits in future years if capacity exists. If you are within the interest limit, if you're within 30% of EBITDA, so if your net interest expense is less than 30% EBITDA, you have what's considered extra limitation spare capacity, and the difference is carried forward and can be freely allocated amongst the group. If interest spare capacity, if you have a higher taxable interest income than deductible interest expense, you have interest spare capacity, and again, that can be carried forward for 60 months. On the next slide, we give an overview of what is an interest group. So an interest group is one in which you must elect into, and if you elect into it, you're into it for 3 years. The members must be companies within the charged corporation tax and are either part of the worldwide group or in a corporate tax loss group. It's very important to consider who will be in your interest group and who will not be. So when we work out, say, the 30% of EBITDA, or we're working out the exceeding borrowing costs, we can add together each member of the interest group's exceeding borrowing costs to come up with the group exceeding borrowing costs, and at that stage, we apply the ratio. It's important to note, however, that the 3 million de minimis applies to the group as a whole and not to each company within the group. This is incredibly complicated, and I'm conscious I've gone through this quite fast. There is another webinar on this on Thursday in the Tax Leadership series, which will spend time going through each sections of this if you wish to dial in and listen to it. If we have a look at the next slide, you'll see that the final section in the Anti-Tax Avoidance Directive is hybrid mismatches. So if we go to the next slide, we'll see it's on reverse mismatches. Reverse hybrid mismatches is included in this finance bill. A reverse hybrid mismatch is an entity which is established in Ireland but which is not ordinarily chargeable to Irish tax, as it treats its profits and gains as accruing directly to the entity participators, so like a partnership, okay? But the tax laws in the country in which those participators are resident treat the profits as arising to the entity, such as partnerships, limited partnerships, common contractual funds. You might see this in instances where there's an Irish partnership which would treat the partners as taxable on the profits as they arise, but the partners elect from a US perspective to be considered a company, the partnership to be considered a company. That could give rise to a reverse hybrid mismatch. On the next slide, you'll see that there's further details and that there must be at least 50% ownership as to those within scope, and the partnership must not be taxed elsewhere. There is an exemption for qualifying collective investment vehicles. If you find your business is within scope of this, then Ireland will impose corporation taxes if it was an Irish resident company. But it's only on the portion of the profits that pertains to the mismatch. If we have a look now on the next slide, we'll see the transfer pricing domestic exemption. So this is the last bit we're going to consider in regards to the international aspects, albeit it is a domestic exemption. There's been a lot of controversy regarding this section and how it operates in practice. 2019, we saw its introduction as to an exemption between domestic companies where it's introduced, between domestic persons where it's introduced for non-trading income or gains. And clarity was sought on the extent of the exemption and how to interpret it. Finance Act 2020 substantially amended this domestic exemption to clarify the technical interpretation that Revenue had taken. However, late in the day, this was put subject to a commencement order and has not come into effect. Finance Bill 2021, we welcome the changes to this section, which further provides clarity as to how the exemption will apply in practice. It also includes 2 specific anti-avoidance measures. Where previously we required both parties to be chargeable tax under Schedule D, the exemption has been widened to confirm that it would also include those that would be so chargeable if an amount was payable. Helpfully, this will include arrangements such as interest-free loans from a tax-resident individual to a trading company, interest-free loans from a holding company to trading companies, and interest-free loans to a holding company to acquire shares in a trading company. The 2020 Finance Act measures that were previously subject to commencement orders were repealed in this bill. That's all from me. Etna, I believe you're going to speak to indirect tax.
Thanks, Lorraine. We might move on to our first slide covering indirect tax, and we're going to start with VAT among the various technical amendments. Let's look at some key measures there. So if we start with VAT rates, the Finance Bill confirmed the temporary 9% VAT rate extension. So that's the extension for activity in the tourism and hospitality sector, with the confirmation that that temporary rate is being extended to the end of August next year. On the other hand, the bill also confirmed a decrease in the compensation that unregistered farmers get. This is to compensate them where they can't recover VAT on their expenditure, and it's called the flat rate addition commonly. So the bill confirmed the decrease in that flat rate addition, that benefit for farmers, from 5.6%, so a slight decrease to 5.5% from 1 January next year. Moving along then in this same slide, another proposed change is the amendment to the VAT treatment of non-refundable deposits kicking in from 1 January. So currently, say if a hotel receives in a deposit and it's non-refundable where there's a customer cancellation, there's an ability to be able to reclaim VAT that was previously accounted for, but there's an abolition of that VAT reclaim proposed on those non-refundable deposits where they're retained by businesses. So one point to note though, before we move further, is that there's no impact here on the VAT treatment of deposits that are in fact refunded to customers. Let's move to the next slide. And another measure in the Finance Bill is to do with VAT grouping. So here we're talking about that discretionary ability on the part of revenue on application by businesses to treat them effectively as one single business for VAT purposes as a VAT group. So first off, the proposal, well, it's more of a clarification really that at least one member of the VAT group must be VAT registered. And in practice, that's what we would normally see anyway. But also there's a clarification that if the VAT group is being cancelled, that the cancellation can take effect from an earlier date before the date of the issue of the actual cancellation notice by revenue. There'll be a new notification requirement. So what's being got at here is that the VAT group remitter, that's the entity that files the VAT group returns, will be required to notify revenue in certain scenarios. And that'll be within 30 days of the end of the bi-monthly VAT period during which something happens. So what is this thing that would happen that would need to be notified? It would be where the conditions for VAT grouping are no longer met, or if there's a significant change to the reasons for having them VAT grouped to begin with. In other words, a change to the financial or economic or organisational links between the VAT group members. And we'll be getting more light shed on this by revenue about what would be considered to be a significant change. However, there can be a penalty imposed here of €4,000 per bi-monthly period in these scenarios if revenue aren't notified, and that would be for each period in which they're not notified. Now, among other technical amendments, we heard earlier from John about the amendment, the penalty regime. There were also changes, for example, to the COVID-19 support measures. So what we see here is that from 1 January 2022, the upshot is to have no VAT payable, in other words, zero rating or VAT exemption applied for certain supplies to or for imports by the European Commission and some other EU bodies that are tasked with combating the whole COVID-19 pandemic. And also, the bill is confirming the extension of zero rating, so again, no VAT payable, for COVID-19 vaccines, for COVID-19 medical devices of some types and closely linked services, with an extension of that VAT treatment to the end of next year. If we can move on to the next slide, let's take a look at customs and excise and some key measures there. So although there were no changes in the bill regarding customs duty, there were a number of excise duty procedural and technical amendments. So looking at some of the key measures on the excise duty side, there was a confirmation in the Finance Bill of that it's one of the old usuals really, the excise duty increase for tobacco products. So what that would equate to is a 50-cent increase, including VAT, on a pack of 20 cigarettes in the most popular price category, with pro rata increases for other tobacco products. Again, there was another confirmation of what had been already expected, upward revisions to the vehicle registration tax bans, VRT bans for category A vehicles. So that's your cars, your SUVs, from 1 January next year. And this is part of the climate initiative to try to reduce emissions. So what that involves is an increase of the current rate of VRT by, say, 1% up to 4% for vehicles. And that depends on which band they fall within this 20 band VRT table. So the increases are aimed at vehicles that fall within the higher bands of emissions from band 8 upwards. On the other hand, as part of the climate initiative, there's an extension of the €5,000 VRT relief. And that's for battery electric vehicles in categories A and B. That's being extended until December 2023. So that's a 2-year extension. And lastly, on the customs and excise side, a key measure involved the continuation of a waiver of the excise duty that would ordinarily arise on the renewal of certain intoxicating liquor licenses. Now that's for the licensing year 21-22, and it's an extension of the existing measure into its second year at this stage now. So at that point, having looked at some key measures on the indirect taxes side, I'm going to hand back to Brian in order to see what questions may have come in from the audience and what's been covered today.
Thank you, Edna. Edna, sticking with you then, just on the questions. The question has come in on the VAT side, and basically what I was saying is, you mentioned the change, the VAT change around forfeited deposits. So what steps should a business take to prepare for the change in VAT treatment?
Okay, no, thanks for that. Well, I think some businesses would already have seen this coming, because the change for the non-refundable deposits, it's trying to bring in a development at EU level, where EU case law that's binding here says that, you know, VAT should be applied without having a relief. So what are the practical steps? It's about preparing to make sure you can have these changes for the 1 January implementation date. What I would do is you take a look at those income streams, which are your non-refundable deposits, your cancellation charges. I'd identify which ones are refundable, in other words, to try to see what are the areas that are not impacted by these changes. And then it comes back to, with regarding what you're left with, the bedrock of non-refundable charges, to take a look at those income streams and see now, are you losing the VAT relief on those? Are you then going to be able to factor in your computation and your budget the VAT cost as a result? And are your systems going to be able to deal with that change? So some of those practical changes need to be looked at, and those practical matters in advance of 1 January.
Brilliant. Excellent, Edna, thank you for that. John, one has come in for you just on the Section 840A amendments, and it's an interesting question actually. It's just asked whether existing loans are grandfathered, so loans that have been in place pre the 21st of October 2021, whether they're grandfathered or whether these new rules apply to them.
Yeah, unfortunately, Brian, as drafted, there's no provision included there that says that it only applies to loans advanced on or after the date of the Finance Act, or the 1st of January 2022. So, in short, I think as drafted, it's probably difficult to read in that there's any grandfathering incorporated.
Yeah. Okay, excellent, John. Thank you for that. Lorraine, a couple of questions have come your way just on the interest limitation rules. So we'll go through these pretty quickly if we can. So first one is, if my interest income is adjusted upwards due to transfer pricing, how does it interact with the interest restriction rules?
Yes, question. It's a good question, Brian. So the interest limitation rule will apply after all other adjustments. So if transfer pricing adjusts your interest income upwards, then that's the amount that will come into your interest limitation calculation. So you'll benefit in that regard from the fact you have to pay more tax on your interest income for the ILR. It's the same, we see this with, say, distribution. So if your interest expense is recategorized as a distribution, then it's only the deductible interest expense that will be within the exceeding borrowing costs. It won't be the amount that's recategorized as a distribution.
Okay, perfect. And then another one just on the group provision. So if a company in a group elects not to be in the interest group, is it entitled to its own 3 million de minimis limit?
It's almost leading the witness, that question. So indeed, it is entitled to its own 3 million if it's not in the interest group. This is where businesses are going to have to decide as to whether they're going to put their companies into the interest group and only have one 3 million de minimis for that interest group, And we might see that where, say, interest expense is quite high, but profits are in a separate entity and they want to benefit from the increased EBITDA from the profits in the other entity. If your interest expense is below 3 million and you're comfortable it will continue like that for the next 3 years, and you don't have, say, that increase in profits you want to use elsewhere for your tax EBITDA, then yes, you would very much keep that outside the interest group and avail of that de minimis exemption.
Okay, and just extending on that about the group measures, if, for example, you have interest on an intercompany loan between two Irish group members, or is that caught by the interest limitation rules, or is there an exclusion for that particular interest payment?
If the interest payment is deductible, it's technically within the ILR. But when we look to the interest group, there's two options of how you add together interest group members. Okay, you can either consolidate them, in which case that interest will disappear on a consolidation. Okay, or we can aggregate them together and they will offset each other. So interest income in one would be added or would offset the interest expense in the other. So again, it very much depends on the circumstances.
Yeah. Okay. No. Brilliant. The final question, Lorraine, that's come for you on the interest limitation rules. John touched upon the amendments to non-resident landlords, essentially bringing them from the charge to income tax to the charge to corporation tax. So as a result of that proposed amendment in the finance bill, does that mean that non-resident landlords are now within the scope of the interest limitation rules?
Exactly, Brian. They're now bringing the charge to corporation tax. So these companies, provided they can get a tax deduction for that interest expense in Ireland, will be within scope of the ILR. It looks like it will appear from 1 January 2022, regardless of the accounting period, on the basis that these companies previously were subject to income tax and now will be subject to corporation tax, begin a new accounting period on 1 January 2022, based on how our legislation works. So yeah. Brilliant.
All right, that's excellent. Well, no further questions have come into the chat box. So, well, I suppose finally what I would do is just thank all of our speakers this afternoon for their participation, and also just to remind our participants about the webinar that's been held on Thursday on the interest limitation rules, where we'll get into a little bit more detail on the provisions that are in the bill, but also what impact they'll have for Irish groups. So without further ado, I'd like to thank everyone for participating this afternoon and enjoy the rest of your day. Thank you, folks.